I appear to have muted myself or somehow got muted automatically. I think maybe as the transcription and recording
Yeah, Mr.
started.
Chair, there appears to be a new pop-up for that. Sorry about that.
Oh no, that's okay. I did get that email on that new policy coming into effect. This is just my first time interacting with it there. So I'll try this again here because I think what I said was on mute. Good morning, everyone. With a quorum and with a packed agenda, I'd like to call our June meeting of the Vermont State Employees Retirement System to order here at 9:03. And the first item of business on our agenda this morning is approval of the agenda itself and any announcements.
I'll move approval of the agenda.
Thank you, Jay. Do we have a second?
Second.
Thank you, John. So with the motion and a second, the motion is to approve the agenda as presented. All those in favor, please signify with an aye.
Aye.
Aye. And all those opposed with a nay. Hearing none, the ayes appear to have it. The ayes do have it, and the agenda is approved. With that, any announcements before we move into the next matter of business this morning? Not seeing any. Let's move on to approval of the minutes from our May meeting. So the minutes from May 14th were included in our packet.
I'll move approval, Eric.
Thank you, Jay. Do we have a second?
I'll second.
Thank you, Betsy. So the motion to approve our May minutes is on the floor. Any comments on the minutes before we move to approval? Any discussion? Hearing none, all those in favor of approving the May 2026 minutes, please signify with an aye.
Aye.
Aye. All those opposed with a nay. Hearing none, the ayes appear to. John, I see your hand is raised.
Yeah, I just have would ask that a gender check be made on my title, which at the bottom of page 1 says Ms. Gothier. If that could be changed to Mr., I would appreciate it.
Absolutely.
A
Apologies.
minor point. That's okay.
Excellent. Thank you. I think so. That will be the minutes will reflect that change. Thank you for the comments and the change. All those in favor of approving the minutes with the modification John suggested, please signify with an aye.
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 Aye. All those opposed with a nay. Hearing none, the ayes appear to have it. The ayes do have it, and our minutes from the May meeting are approved. Next on our agenda this morning is public comment. Are there any members of the public that would like to put comments on the record for the board this morning? If yes, please raise your hand or simply unmute. We do have a little bit bigger of a audience this morning, so I just want to confirm that no one is offering comments this morning. Seeing none and looking through the participants a bit, I think I feel comfortable saying that no members of the public are offering comments at this time. And I'm just taking my time here in case that is not accurate. But still seeing none or hearing none, I feel comfortable moving on to the next item of our agenda, which starts to get into the the thick of it here, with the update to our experience study and recommendations from Siegel. So with that, I think, Tim, do you want to tee this item up at all, just to sort of give some overarching perspective to the process and so forth, and then hand it
Sure.
off? Okay.
Yeah, that'd be great.
Great.
Thanks, Mr. Chair.
Thank you.
So following Act 114, we are now on a 3-year cycle for doing experience studies. For new board members, experience studies are the big study we do to check our assumptions every few years. And it used to be 5, and now following Act 114, it's every 3 years. We did experience studies in 2020, 2023, and so now in 2026, we're due for that look under the hood again. What we're doing here is looking at most recent experience, what we think is going to happen in the future, and we're truing up sort of, all of those demographic assumptions that this board has authority over. In the past, this board also set the economic assumptions. That's the inflation rate, the rate of return, and the asset smoothing method. Sorry. Those assumptions now sit with VPIC, and they have just reviewed those in their most recent meeting, and they kept the rate of return steady. As you'll see in this deck, they increased the inflation assumption by 10 basis points, and they kept the asset smoothing method the same. So what we're going to be really focused on is the demographic assumptions, even though the inflation and some of those economic assumptions play into them. So I'll let Matt and team walk us through all that. What we are looking for at the end of this is for, these are the board's assumptions. So if you have questions, please feel free to engage, discuss, and all that. But ultimately, we are hoping that the board will consider approving these assumptions or as modified going forward. So with that, Matt, I'll turn it over to you.
Yeah, thank you, Tim. Thank you, members of the board. Austin, would you please share the presentation and jump over to slide 3? And just so everyone's aware, we do have 2 other members of the team. Patrick and Maria are also on. So if there's a question that really gets into the weeds, we may elect to punt over to one of our helpers. But those are our 2 colleagues that are on with us. And yeah, go to 3. I think, Tim, you covered this pretty well, but just at a very high level, think about the valuation process each year. Like, we're dealing with the liability side, and so what we're trying to do is for all the current retirees and all the future retirees currently in the system, we're trying to project out what their benefits are going to be, not only 1, 2, 5, 10 years down, but even out, as far as 80 years into the future, and then discount those back to present value. And as you can imagine, in order to calculate, project out those amounts, estimate the amounts, and project how long they're going to be paid, there's a long list of assumptions that go into that. So this is our chance to, well, the one thing we know is that the assumptions will never be exactly right, but this is our once every 3 years to kind of look back and make tweaks to the assumptions to steer them in the right direction based on past experience. With the 3-year cycle, so the last time those assumptions in the last experience study would have been adopted effective with the June 30, 23 valuation. So at this point, so if you think about 7/1/23, so we really have those the last assumptions were used in the fiscal 24, plan year and the fiscal 25 plan year. They're also getting used in the fiscal 26 plan year, but that only, that ends in 20 days. So we don't quite know the gain loss and how those worked for that year, but we do have 2 years. So I would say that's, you'll see where that comes into play. Austin's got a slide a couple of pages down where we really just have 2 years of gain loss on the new assumptions, but that third one we'll be developing in the fall, and we'll kind of know how that shook out. Yeah, and the last parts of this, Tim, you covered that really well, that we will kind of skip through how we looked at the inflation and investment, but we really don't have we really didn't set those. Going on to 4, so there's kind of two houses. Yeah. Okay, never mind. There's really two houses of assumptions. There's the demographic house and the economic house. Most of the demographic ones are studied based on past experience. And in most cases, except maybe mortality or other special cases, you're kind of looking to take what the traditional legacy assumption has been, how did it fare, and then you're blending it with the most recent 3 years of experience to kind of course correct and recommend a new assumption. Mortality is one where you're looking to more so set that as best as you're picking the most recent base table, and to the extent you can, you're modifying that to match your most recent experience. And then economic assumptions tend to be very forward looking. Keep in mind, there's really no right answer. We're always going to be wrong to some extent. And then the other thing is that the assumptions are long term. So we are looking out for things that are 10, 15, 20 years into the future. So even though we might say, well, we know salaries in the next 2 years, for example, they're going to be lower or higher than expected. Those things just they kind of come out in the wash as gains or losses because we want to set these assumptions with a long-term lens. 5 is just again showing these two broad classifications that we reviewed, but we're going to talk about these really in summary over the next couple slides. Starting with number 6 with Austin, if you want to look at the experience.
Sure. Thanks, Matt. So this slide includes a historical gain loss table that's similar to the version that's included in the valuation report. As Matt kind of mentioned, the purple line is effectively a cutoff between the gain loss amounts that were tied to the prior assumptions and the gain loss amounts that were tied to the assumptions that were updated per the last experience study in 2023. Some of the highlights to point out are there's higher turnover than expected, which resulted in gains. And during the prior study, we actually recommended no changes to the turnover rates due to the anomalous experience related to the pandemic. If you recall, that experience period was pretty much strictly COVID years. So we ended up kind of holding off on that assumption and waiting till this current study to look into it. During this current study, we did recommend increasing the turnover rates to align with the experience that we were seeing. The retirement experience resulted in losses. Pretty similar in magnitude to the previous years, maybe a little bit lesser than some of the years, but similar to termination, we recommended no changes to the retirement rates in the prior study either due to the anomalous experience we were seeing. However, during this study, we did recommend appropriate changes to the retirement rates. And also new for this study, we recommended adding a service purchase upon retirement load assumption, which we have another slide later in the presentation where we'll discuss this in more detail, but this will be one of the new assumptions that we're recommending to apply to the plan this year, or actually for fiscal year 26.
Hey, Austin, before you move on to the salary, because I think we will look at the retirement detail a little bit, but I think we're not going to look too much at the turnover. But can you just describe what we ended up doing because we kind of punted for 3 years and then we had 6 years of experience? Could you just describe what we ended up doing with the 6 years or the 3 years and the process a little bit?
We have the summary on the next 2 slides a little bit. I was going to go over those 2 slides in a little more detail right after this, but so I guess just quickly while we're on this slide, I'll just go over there were higher than expected salaries, which resulted in losses. However, we did recommend no changes to the non-inflationary component due to the high actual inflation that was experienced over the last few years. And we have another slide a little bit later where we'll kind of go over this in more detail. But we did end up increasing the inflationary component, which aligns with the increase in the inflation assumption from 2.3% to 2.4% per VPIC, which was updated this year.
But before you move on, I just want to dig into something Matt mentioned earlier, and you can see it here on this slide. I just want to make sure I have sort of the timing of these changes correct. So when we you can see here the 2 years that we can, we have certainty over in this experience review 2024 and 2025. So when we look at the 2026 valuation, it's going to be sort of graded against the experience figures that we previously adopted. And then any changes to liabilities and ADEX related to changes we may approve would come into play after the 2026 valuation. Is that just to have the timing of that right?
That's right.
Okay. Great. Thank you.
Sure. All right. So now kind of tying back to the turnover and the retirement. Go ahead.
Sorry, can I just jump in on that? Because I just want to make sure that we're clear. I think we're grading the FY26 on against the prior assumptions. But Matt, it's right that as you're setting liabilities in the FY26 evaluation, you will be baking in the new assumptions looking forward. So it will.
Awesome.
So this study will, it's the year where you're looking at the old assumptions to say how'd you perform over the last year, but you're utilizing the new assumptions to say what's our long-term liability going forward. Is that fair, Matt?
That's exactly right.
Okay.
Thank you. Appreciate that clarification. I see Commissioner Gresham, you have your hand raised as well.
Sure.
Floor is yours.
Yeah, thank you. I just wanted to make the point, this chart seems to speak to it, that it seems that our experience, if that's the way you want to call it, has been almost uniformly negative. And, I realize that's based on assumptions we've made, but I think if we look back 15, 20 years, what we would discover is that pattern has held in that investment experience has been, or investments have been up, they've been down, depending on what the markets do and how good we anticipated. But it just seems to me that almost without exception, our net experience has been negative. And, I would just say that it seems like we're missing something. And I can't help but comment on that. And I'm seeing the exact same thing. If you go back 10 years, you'll see the same chart. You go back 20 years, you'll see the same chart. And it just seems like we're missing something in our calculations of experience.
I don't disagree with that. I don't disagree with that observation at all. I wouldn't say it's isolated to the VSERS plan. I mean, I think you get this going across the country, that a lot of times the assumptions are maybe set with like maybe a tiny bit of optimistic lens that like once you look with a in the rear view mirror, they become optimistic, but at the time they don't really seem like they're optimistic. The other thing I'd point out though is like it's almost like like a boat that's got a bunch of holes in it and the water's coming in and you plug one and then another one comes up. Because if you look here, like the turnover assumption has been running gains in these 5 years pretty substantially. But probably early on they were running losses, and so that assumption was addressed. So now they're running gains. The COLA has been really the biggest negative recently, and that's tied to actual inflation, which has been high over the last 5 or 6 years. So we know that's kind of been crowding out a lot of the other experience, because the COLA experience has been losses. So it's like, I agree with the observation, but I think you can kind of go through each 5-year period or 3-year period and point out like that there was some cause for it. So like in the investments, it's like the investment assumption was always seemed to me maybe a little bit, 8.5%, we can make that. And then you hit a period where it was the wrong answer. It was lower. And then you sit there and you're like, well, of course 8.5% wasn't the right answer. It should have been 7.5 or 7. So that's kind of my reaction to that, to first say, I completely agree, but kind of looking at where some of the buckets are, they look sort of explanatory. And again, with the other big losses here are with salaries, which again have been higher increases. And that probably wasn't the case. I think the negative numbers in if you went back in different 5-year periods, the negatives would show up in different places. But like what you're saying is when you go down to the bottom line, you're always kind of getting the net negatives. And I don't disagree with that.
Can I make a quick point there? Can I share my screen just for a second, Austin?
Sure.
Just want to your point, Commissioner Gresham, I'm pulling up you guys see that how did we get here chart? So this was from our risk assessment that we did last year, and particularly look at the dark yellow color. I think what these dark yellow bars are showing are when we've made assumption changes. And we've recognized additional liability. I think to the point you're making, Commissioner Gresham, that like our assumptions have been overly optimistic in the rearview mirror. And as Matt was saying earlier, what you're doing is kind of looking at recent experience against the assumptions, and you're kind of blending that experience in. You know, the thing that stands out here is we all probably remember pretty well is 2020, the big change from 7.5 to 7%. That was a big course correction at one time, and it had a really outsized and painful impact, I know, on state budgets. So, you know, I think the point I'm driving at here is that I think this is the way that we've been trying to address that over the past, 10, 20 years, to bring the assumptions more in line, recognize the liabilities earlier, and sort of mitigate the losses that we're seeing. Totally, I don't disagree with any of the things you're saying. I think I just wanted to point that's sort of the way we've been dealing with them over time.
And with respect to the retirement one, and Austin's going to talk more about this, but retirement losses is one where we really feel like we have a pretty good handle on when people are leaving and at the rate people are leaving. So we do feel like there's something else going on there that we're trying to introduce kind of a new assumption onto the retirement piece to, again, address the mitigate losses going into the future.
All right, sorry about that. Does that look good now? Sharing the screen.
Mhm.
Yep.
Okay. All right, so moving on. So kind of tying back to what Matt mentioned about the turnover and retirement experience during the previous study. So during the previous experience period, there were relatively large retirement losses and relatively large termination gains that were generated due to the anomalous experience that was likely related to the demographic aftershocks caused by the pandemic and pension reform. And we didn't expect that experience to be indicative of future trends. So as a result, we ended up recommending no changes to both the active retirement rates and the turnover rates during the prior study. And we had the plan to reassess during the current experience study. So during this study, solely for active retirement and termination, we analyzed the last 6 years of historical data from July 1st, 2019 through June 30th, 2025, effectively both of the experience periods, to see how the experience ended up looking for both of those assumptions. So for active retirement, the experience during the current 3-year period was relatively inconsistent, or it looked quite different when compared to the experience from the prior experience period. So as a result, we decided to solely analyze the experience from the most recent 3-year period, basically like we did for most of the other assumptions, to determine how the active retirement rates should be adjusted. And since we solely use the current 3-year period, we use a standard 50-50 weighting approach between actual and expected experience, which is similar to the approach we use for most of the other assumptions as well. On the other hand, for termination, the experience from the current 3-year period was relatively consistent, or it looked quite consistent when compared with the experience from the previous 3-year period. So as a result, we decided to analyze all 6 years of experience together solely for termination to determine how the rate should be adjusted. And then since we use this 6-year period, which is basically making data more credible by having all of this actual experience, we use a 75-25 weighting approach between actual expected experience when proposing the updates to the termination rates. So we moved basically for termination, we moved a little bit closer to the actual experience because we had more data available to use for the analysis.
So let me just recap that. Retirement, the last 3-year period that we skipped, we ultimately decided to completely punt on that, and it's completely ignored.
Mm-hmm.
For termination, it actually, the 6-year period was consistent. So by taking the 75-25 weighting, it's as if you get basically to the same place as if we would have recognized it last time at 50-50 and then applied it 50-50 here. So it's basically saying, wow, the last 6 years has been pretty consistent. Let's blend everything like we would have, like if we would have done it the last experience study.
Mm-hmm. Exactly. All right, now I'll pass it back to Matt to finish off the executive summary slides.
Sure, and this one is related to mortality, and what you're seeing on the bars are in terms of benefits released due to mortality. You're seeing the dark blue on the left is what we expected for male retirees, female retirees, and then all beneficiaries on the right. The teal is the actual experience. So there were, for males, slightly fewer deaths than expected. Females had more deaths than expected, and beneficiaries had slightly more than expected. And then you see the purple is the proposed. So the biggest update is that we were using a series of tables called the Pub 2010 tables from the Society of Actuaries, which is based on all public sector experience, had a central year of 2010. So it was effectively like 28, 29, 2010, 11, 12, and some 13 experience. That series of tables were updated with a central year of 2016. So it's pre-pandemic experience, but it's like 2014, 15, 16, 17, 18, and a little bit of 19, half of 19. So we certainly wanted to move to the most recent base tables. And then what we do is, to the extent that the size of your group is large enough, there's some models out there that's based on the number of deaths, then you can weight your data based on credibility to certain percentage, and then to the off-the-shelf tables to a certain percentage. The size of the groups, I think the largest groups allow us to do like a 50-50 blend, and some of the smaller groups, we pretty much have to rely on the table as is. The 2016 tables did have they do reflect lower liabilities, more deaths. And so to the extent that basically what we're seeing here is that, to the extent that we can't totally blend to the VSERS experience, we're left relying on the experience of the table, which have slightly unhealthier compared to the prior tables. So you will end up seeing that by the time we go through the process, with the new base tables, and then we put in a new mortality improvement scale. That's the part that says, okay, well, we're sitting here in 2026, but I really care about mortality in 2036, 2046, 2056. There's a scale that improves the rate of improvement over time. So we know people tend to get healthier. That has dialed back a little bit. Still, no new tables have been released that have post, the COVID period mortality improvement expectations, but there is a new kind of scale that's put out suggested by the IRS that adjusted the 2021 scale. So since it's the most recent one, we've adopted that. But what you're going to see is that this causes a decrease in liability, even though we maybe had some mortality losses. What that basically says is just that the mortality loss, because of the size of the group, the mortality losses could be considered, maybe anomalous, and you really are left relying on the mortality tables as they're published to the extent we can adjust them. So that's my comment on mortality. The next slide are,
Matt,
yes.
yeah, I had a question on that one. It just, the male retirees looks a little different than the other two groups. And I wondered if you'd comment about why the proposed is above the previous expected, as much as it is when the actual is so low in that group. I'm just talking about the relative height of those bars.
Yeah, you're totally right. And with a group with an enormous group, like New York State teachers, for example, they would have enough experience that the adjustments that you're allowed to make to the proposed rates, that the purple lines would almost exactly equal the teal. So you would expect something, what actually happened, then you adjust the table so much so that you hit the teal exactly. The adjustments that, like the unadjusted purple is actually taller, but we're allowed to blend it some. So it's got actually, more liability being released to the new tables have more liability being released than the current tables, but we're actually able to bring that down slightly, but we just can't bring it down to even where the prior expected was, which is why we see a little bit of a liability decrease. But it really has to do with the mathematics behind it, saying, well, you had this for males, $6.8 million of liability released, but that was just a little bit more random because of the size of the group. It is not perfectly credible.
Right. Okay. Got it.
On the economic side, we talked about the 7%, the inflation 2.3 to 2.4. Austin's going to talk more about the COLAs, but if you think about a 10%, 10 basis point increase in inflation, that drives, either a 5 or 10 basis point increase in the COLA assumption. And then we have an admin expense load of 45 basis points that looked like it's still a pretty good assumption, so we don't recommend changing that. And then kind of looking at the impact, we've grouped these in really like three broad groups. So I would probably focus on the accrued liability. That's the second row. On the last year's valuation, we were at 3,948,000,000, just reflecting the COLA again, which for depending on the group was either an increase of 5 basis points or 10 basis points in the assumption. That's worth about 0.8% of liability. So that looks, what is that, like $33 million. And then the mortality one had that decrease. So that was basically, what is that, like $65 million decrease. And then all other assumptions. So these are like the salary scale, the tweaks that we made to the retirement assumption, the new retirement piece that we did for reflecting service purchases, and then what we did for the turnover, things like that, basically increased the liability back by about $40 million. So on a net basis, it's a very small increase in total liability, but there's different levers that are being pulled. But it ended up being like an $8 million change in liability. Looking down at the last one, which is kind of the contribution amount. Again, these are based on last year's numbers, which will apply these, but we're using this as a proxy. The $140.5 million contribution would, under the new assumptions, would change to 140.4. So not a very big change, although independently all the the assumptions are all kind of going in different directions. But the net impact is pretty small.
Yeah, Matt, I just wanted to pause on this because I think this chart really kind of is, if you're looking for the story of this experience study in one chart, I think this is it. When we're looking at the COLA inflation assumption and then all the others, we're seeing some additional recognized liabilities, but mortality, given the changes in the tables from using the more updated ones and then blending as Matt described, that's where you're seeing the more of the liabilities released, about an equal measure to what all the other assumptions do. So just wanting to pause there to emphasize, from the highest level, that's sort of what the story of this experience study is.
And I'll comment on the mortality one too, because I think, again, we've got 3 years, which limits the credibility. The 3 years netted out to be, I don't think it was like this every single year, but the 3 year in aggregate netted out to be better experience, meaning people lived longer than we thought. But like I said, the base table, which is based on a lot more data, says, actually mortality levels are a little bit worse. So I mean, so we're left to kind of default to that. But if it turns out that we like the next 3 years, so we do this in 3 years, if the next 3 years net out to be really similar to the current 3 years, we could take a strategy of just taking, all 6 common years together, which would really boost up the credibility of the group. We'd be able to apply a bigger adjustment to the table, to the base tables, and be able to reflect your experience more. But we're kind of left with relying on this larger data set, and more than your own experience from just the 3 years.
We're a pretty healthy state, but that I would trust the larger numbers personally.
Right. Okay.
One more question before
sure.
we leave this slide, if you don't mind. I just want to kind of pick apart the different ways that the inflation assumption affects various rates. So if the all other assumptions, if you follow the footnote down, that column includes the effect of increasing the inflationary component on the salary scales. That's the part of the inflation component that's sort of pertinent to our charge here. Like it also affects some of the investment assumptions, but that's sort of already kind of baked into what VPIC does. What I'm wondering is, are we seeing the full impact here of the inflation assumption increasing? Is sort of essentially what I'm getting at. And I think the answer is yes, because it's already embedded into the investment piece, and then the piece that isn't is how it affects the other assumptions, which is what we're seeing here.
Yeah, and actually, I think your point's gonna be made on the next page, Austin, on 12. So the inflation. So we want it to be consistent. The same inflation component is used in all the pieces. But like for COLA, we know when the inflation goes up, that improves COLAs for your plan. That's a liability loss. For salary increases, that projects higher salaries. It gets a little bit nuanced there, but at the heart of it, the higher salaries mean higher benefits for active members when they ultimately retire. There's a component of that is, but then spreading that out over a member's career as a level percentage of pay, there's a little bit of offsetting, but that's like now we're like an actuarial weed territory. But I do think of it as being an increase, but it's kind of offset on a present value cost basis, like a first year cost, because you have higher projected payroll over a person's career. And then payroll growth, we will talk about that one, but that's another one that for purposes of what we use it for your plan, it's that projecting out the budget contribution for the next fiscal year. So when we do the 26 valuation, we have to project out normal cost by payroll growth to get to fiscal 28. And so that's going to end up being like, a little bit of a higher cost with a higher inflation, because it's all built in there potentially. And then the investment return, it is a component. And actually that is one part I wanted to pause on. So I'll make that point when I get to that slide. Austin, 13 is, Yeah, this was just focusing on the inflation. They picked 2.4. If you go to 14 without a lot of words on this slide, you can kind of just skim over the bolded numbers and you can see like a 2.3, a 2.4, 2.4, 247, 225, 2. Like the ultimate support seems to be 2.4. So we really didn't have a problem with 2.4 at all. A lot of the data elements are pointing towards 2.4. It wouldn't be surprising. Again, we're all feeling inflation. And first of all, an increase wasn't unexpected because we're sort of feeling it and we continue to feel it. So at some point in the next several years, a tick up to 2.5 also probably wouldn't be surprising, but it also wouldn't be surprising that 2.4, we live with 2.4 for quite a while too. It's just kind of really historically an under the radar type assumption that now since we're all feeling it, it's like you find out how kind of challenging it is to really predict this one.
Yeah, and Matt, on that, this was just to like make a point for what to expect this year in the valuation, and sort of looking back over the past few years, for really a number of years, this was our largest source of gains, was inflation, when it was running very cool. And so, even if we'd have losses in other categories, we would often see COLA below the 2.3%, the inflation below the 2.3% amount, which produced gains in our system. Just today, the CPIU Northeast for May was released, and that's 5%, up from 4.4 in April. Given everything going on, I wouldn't be surprised if there's another tick up in June. And as folks may know, year-end June is our measure of inflation that we use to apply to COLA. And so when you're looking at like where there's going to be a source of loss, regardless of if it's 2.3 or 2.4, even 2.5, we are in a period of time right now where the actual inflation is going to drive losses for this coming year, and I wouldn't be surprised if years to come. But as Matt was saying, that goes in cycles. After we had a good half decade of gains in that area, now we're kind of in a space of seeing losses. So the model is just to look over the long term, and it's just going to be this will swing a little bit harder than other assumptions will.
Thank you, Tim. Betsy, I see you have your hand raised as well. The floor is yours.
Yes, thank you. And sorry if it's just such a naive question, but given that the inflation that's reported on slide 14, the 5-year, 10-year, well, everyone but the 10-year has been, I'm sorry, the 20-year, they've been well in excess of what you're projecting, and our current inflation rates are much higher than 2.4%. So just help me understand why we're not projecting a higher rate for inflation.
Yeah, I think the thought there is like the demographic stuff is mostly your best guesses at it are looking at past experience and then applying that to the future. Whereas some of these economic ones, there's people that get paid, a lot more than I do, that are projecting out, what they expect inflation, and there's maybe even sometimes an active hand in that. Like the government can sometimes do things that adjust inflation, and they can target. I think they're still targeting like 2% long-term inflation, which doesn't seem realistic. But a lot of these numbers here, we're looking at like surveys of investment consultants that have economists that are projecting out, 2.4%. Siegel's investment advisors, Siegel Marco Advisors, they're using a 2.4% assumption. Again, they're looking at it over a 10-year, sometimes a 20-year period. You can look at what the bond market, so with like 20 and 30-year bonds that are inflation index versus non-inflation index, theoretically, the delta between those two yields is what the market expects long-term inflation to be. And that's like 2.47 for a 20-year period and 2.25 for a 30-year period. So the market, I find that one not to be real reliable, but it is a measure that markets are you can't really game the market, the broad market, because there's so many people buying these bonds. So it's supposed to be a pretty good indicator. And then Social Security does a report. They have their experts that are still relying on 2.4. So, again, this one's sort of out of our wheelhouse, but when, as VPIC works with their actuary, we weren't totally surprised to at least see a movement up from 2.3 to 2.4, but it's not like, oh, the last 30 years was 2.55, so we should be at at least 2.5. They don't really use the past experience, kind of like how you don't use that for the investment return assumption either. You look back to see how you've done, but every time you make an investment in a mutual fund, there's always the disclaimer that says past experience is not to be indicative of future expectations. So I think that kind of applies here too. Speaking of the investment rate of return, kind of where we were for the current assumption at 7%, if you add the two components, 2.3 and the current two, or the old 2.3 inflation and the old 5.08 real rate, we were sort of at like a 50-50 break even of 7.38. So like our 7% assumption basically gave us 38 basis points of cushion, if you think about it that way. So we had an adjustment for conservatism. On the next slide is the detail, but I would focus on the right column. So with the new 2.4 assumption, the current capital market assumptions that we used our non-inflationary return is like 4.74. So we add those together and we'd be at 7.14%. So we're still over 7. We have more of like our cushion. We've dropped from 38 to 14 basis points, which basically kind of drops like our confidence level of meeting or exceeding it from like, I think it was like 54% down to 52%. Interestingly, this is sort of where inflation comes into the investment return. It didn't have an impact here because like had we still been at 2.3% inflation, you would add those together and your expected 50-50 would have been 7.04. So we would have been like at 7% with a really small cushion. But you could see if the geometric return was maybe 4.64 with a 2.3 inflation, we would have been at a 50-50 of under 7%. And that might have been a situation where, the discount rate would be lower in that case. But then in that case, the 2.4 inflation might have actually jumped up, being able to keep the 7%. So that's the one place where the inflation has an offset. Like sometimes you're seeing higher costs on the salary scale or the COLA, but sometimes the inflation can help you on the discount rate, could prop up the discount rate assumption. So as we know, as that goes down, that increases, and when it goes up or when you're able to maintain it, it prevents liabilities from going up. So the inflation does have that one part that's contrary to like the other increases that you see. And then the last place is, well, not the last place, but another place is with the individual salary increases. And again, we look at this with the total increases, but then we subtract out, we really want to look at the non-inflationary increases. So an example would be, just to make the math easy, if you had a 4% assumption, but 3% was theoretically due to expected inflation, your assumption for the kind of the purple or the green and the orange on this graph together would be like a 1% excess. And then if you had a period of 8% actual increases, but inflation was like 6%, well, you're really looking at the 2% excess. And the comparison, even though you were expecting 3% inflation and you had 6%, that's all, you're trying to strip that out. You're really looking at the fact that you expected a 1% excess and got a 2, so you would kind of merge those together and apply a 1.5% excess going forward on top of whatever your inflation assumption is. So when we looked at what actual inflation was over the period, we kind of go back a year for timing. So with the period 21 to 23, actual inflation was 5.61%, kind of like right up to the experience period. There was a lower year of only 2.89% inflation, but just because of like the last year of the experience, like the 2004 inflation would never have had time to like make its way into the experience data that we had. for fiscal 25, because those salaries would have been set for the year long before we actually experienced that inflation. So on slide 18, what we found was the non-inflationary increases that we expected were 2.85%. The actual increases in aggregate for low service people were actually positive, but for most employees were kind of like negative, so they didn't keep up with inflation. The actual was like zero, effectively zero. So basically, this was a case where this is a case where we want to, because of the high inflation and just how it worked out, we'd feel more comfortable not necessarily recommending like a drop to the salary scale, but take a wait and see on this one and take a look at it in 3 years. So we think we would just leave it alone, except for the fact that we are increasing the inflation the inflation was increased from 2.3 to 2.4. So we would have a gross increase in the salary scale assumption, but only due to the inflation. We wouldn't want to necessarily drop or drastically drop the non-inflationary component, because it could be that it was just such a period of really high inflation that we would hate to do too much of a change to that when it really wasn't warranted.
Yeah, Matt, so if I could just, the way I think about this is, we're setting our inflation on assumption on long-term expectations, even while we know that in the short run, it's probably going to be higher than what that long-term rate is. When we see this, the actual increase here about flat on the non-inflationary piece of salary scale, the tendency would be to reduce that piece, like project lower salaries, and therefore release lower long-term liabilities. I think the fact that we're Matt and team are recommending to keep this flat is sort of a tacit way to acknowledge the fact that the inflationary component of salary is going to be there for the next few years. So let's just leave that a little higher, bake in a little conservatism in that way, and rather than just lower it to follow this data. This is one of these areas, I think, where there's some judgment that Matt and team are using, that looks at the experience period but says, it might not be the best move to just follow that number exactly. Is that a fair way to characterize it?
Yeah, exactly. Just because it happened doesn't mean that you need to necessarily react to it, especially, we kind of know that it was maybe not anomalous, but we'd like to see some more experience. Certainly was extreme.
Yeah.
They're just hitting back on that. I appreciate that explanation. I saw on the bottom of another slide, the opportunity to build in some measure of adverse deviation. It made me think of Commissioner Gresham's comment of, if it's seen, if there's something else that may be happening, is it appropriate to build in some sort of component of adverse deviation to kind of cushion against that? So I'll just put that out as sort of food for continued thought, but I appreciate how it's figures into this adjustment, or in this case, lack of adjusting. So just wanted to note that.
A question: Does turnover have an impact here?
No, I think we're looking at increases. We really are looking at the increases for people that were there both years, like at the beginning and at the end of a year. So that's right, isn't it, Austin? And I know for people that I know on the front side, like if someone was new and they worked a half year and then they worked a full year, like we're not assuming like a 100% increase in there or 50% increase. We annualize that first one, but on the back end, I don't think we, if anything, we would annualize it. But we usually sort of are looking at the people that are there in both both
Yeah,
time
it's
periods.
for continuing actives because we compare the actual salary increase to the expected salary increase. And it wouldn't make sense to compare if you expect someone to have a large salary increase, but they terminate halfway through the year and then it looks like they have half the salary, but that doesn't accurately reflect the salary increases. So it's essentially for continuing actives and not impacted by turnover.
So what you're saying is it's probably biased for the data is biased for people that were unhappy with their salary and quit. We're not including them in the data, I guess, but we'll have to live with that. There's enough people that are there that we can ignore that real life detail.
Yeah, but in the aggregate though, turnover does have an impact here on total payroll.
Mhm.
You tend to lose higher salary employees and replace them with lower salary employees doing similar work. And I wondered if that reality has an impact here.
Yeah, not necessarily on the individual increases. I mean, we want to think about that in terms of this next assumption, which is total payroll growth, because like again, the amortization, so theoretically you want your contribution, the budget people would love the contributions to be a level percentage of something, and usually that something is the total payroll of the group. So you can say, well, the plan costs us, it always costs us, 15% of pay. So and then because all your components, your normal cost and your amortization are both lined up like that. In the case of your system, the amortization component has a fixed 3% escalator on it, but at least on the normal cost piece, we use this payroll growth assumption to say, because we think we know normal cost in the valuation is developed as a level percentage of payroll. That's the method that we're using. So we want to be able to project out the normal cost to that next fiscal year to be able to make sure that you're getting enough money because of the timing mismatch. You have to give them a number for 28 in this year's valuation. And this is that assumption. And Austin, we'll go through this real fast, but because we didn't, even though there's data, so we're currently at 3.5% assumption. So it's the theoretical piece plus a plan specific adjustment based on what we're seeing. Some of the underlying components, the data has changed. Just walk through the next one, Austin. I mean, some of this has changed. We know we changed the inflation. The productivity data has changed too. But really the driver on page 21 is like what's actually happened, and the higher increases in payroll that we've seen in the recent time, we feel like has been driven a little bit by the increase in the membership. So like a 4.9%, that's the 5-year average increase in total payroll. Like 1% of that is due to membership. So like the payroll portion, I think of it as like 3.9. And over a 15-year period, it was like 3%. So I don't know. I think when we eyeball this, we still feel like there's no reason to change the 3.5%. So on 22, even though the underlying components have changed, we still just feel like it's not used throughout the thing, but for the one part that it's used, it still feels like we want to project out the normal costs by 3.5% to that next year. Again, just to make sure that we're requesting the right contribution. Yep, and then go on to COLA, Austin. Thank you.
Yeah. Yep. Thanks, Matt. So over the next few slides, we'll briefly discuss the recommendations as they pertain to the COLA assumptions and the administrative expenses assumptions. Regarding the COLAs, there's varying provisions dependent upon group and eligibilities. And I'm not going to go through each of the provisions listed on these slides in detail, but the one key differentiator to keep in mind is if a provision is tied to either the total change in CPI or if it's tied to 50% of the change in CPI. Like for some of these assumptions, 50% versus the total change in CPI. So since the inflation assumption was updated to 2.4%, we performed a stochastic analysis where we applied each of the respective provisions and simulated thousands of trials to model this 10 basis point increase in the inflation assumption and how it would impact the various COLA assumptions. And the results ended up being quite intuitive, as for all the groups that had a provision that was tied to 100% of the change in CPI, the proposed COLA assumption increased by 10 basis points. And for the assumptions that were tied to 50% of the change in CPI, it resulted with only a 5 basis point increase in the COLA assumption. It's kind of similar here, either basically a 5 or 10% basis point increase based on the COLA provisions. So this next slide regarding the administrative expenses assumption, the current assumption is that administrative expenses will equal 0.45% of projected payroll. That was projected from the prior fiscal year. The table on this slide shows how the actual expenses have panned out over the last 3 years. And since actual admin expenses emerged reasonably close to the current assumption, we recommended no changes to the administrative expense assumption. We believe the 0.45% is still reasonable. So now, since we kind of briefly touched on mortality earlier, there's a bunch of deep slides with additional details regarding our mortality analysis, but we're going to kind of skip through these. But for referencing, if anyone wants to look back after, there's slides 28 through 48, I believe.
Yeah, and well, as you're kind of go, you can probably go all the way to 49. And as you're feeling well, we're skipping all this. Keep in mind that this is really our report. We don't do a separate Word document. So there's this information needs to be here, but it is really for like another actuary to kind of go in and to review if necessary, because with the ASOPs, the actuarial standards of practice, we need to disclose like all the work that we did, but it's kind of getting into the weeds that we don't need to spend your time on. But I did want to look at the retirement. This page is just basically saying, what the different groups are, and how they're being separated. And a point to make here is that for retirements, we do look at the experience like on a projected benefit basis. So it's not a matter of just the number of people retiring, but we like to look at what their average benefit is. And if you think about it in terms of like, a hospital plan where it has maybe like 15 surgeons, but 45 nurses, if you were trying to base experience on when people went out, it might be, geared towards like an age 62 retirement, but really when a surgeon goes out, wherever they're kind of driving the liability. So if you did the analysis based on like their expected benefits, you might end up getting like, an age 60 retirement that you're applying to everyone, knowing that on a weighted average basis, you're going to minimize your gains and losses. So that's kind of what you typically do for retirement experience, is you're looking to capture the benefits when they leave, not necessarily the people. On 50, again, a very small group. So in terms of benefits, the exposures are in terms of benefits in thousands. So we're looking at, $6 million. There were very few retirements compared to expected. I mean, we're not making a change to the group. There's just not very many people there. The next group, again, another small group. We did recommend a little change here to increase. This is a little bit, the group C is a little bit of a bigger group. The group A is not that big. But as you get to like slide 52, groups F and G, we break these out into gender. So these are the females. If you look at the lines, they're all very similar. And even in the table, it shows you, the actual to expected. A ratio of 97% is basically saying like in aggregate, yeah, maybe the details are a little bit different, but you're pretty good about capturing when people are leaving. And so we made a little bit of a change there on slide 53. Again, for males, we were off but opposite. So we had a little bit more retirements than expected. But again, we kind of split the difference and are back to like basically trying to fit the experience exactly. So what that tells us is that, over the experience period, the retirement rates were predicting when people were going out, I think pretty well. We only had to make minor changes to them. And so I mentioned earlier that perhaps there's something else going on, which has to do with, people are retiring, but then they're showing up with a higher liability than what was projected. Not so much that they're going out at the time that a different time than we expected. And that's due, we think, to people purchasing service, which, the fact that they're paying for it is not part of the liability. And so typically, when there's a net neutral cost and maybe there's not a lot of people doing it, you sort of just you can get away with ignoring that. But we feel like on the liability side that it's posing a bigger impact on the liabilities than maybe historically had been, or just now is the time to kind of do something. So I want Austin to kind of walk through what the data was and what we tried to introduce to try to on top of the retirement experience to capture this, mitigating these losses going forward.
Sure. So back on the executive summary slide, we referenced that service purchase upon retirement load. This slide just contains a little bit more detail about the analysis and the resulting proposed assumption. So kind of just to quickly summarize, while analyzing the active retirement experience and comparing it to the current assumptions, it appeared as if the rates at which people were retiring were pretty close, kind of like Matt explained, as you saw in some of the prior slides, but they were still generating retirement losses each year. So upon our investigation, an area where liability seems to be creeping in unexpectedly, it seems to be tied to the large increases in service upon retirement for some members. So in attempts to address this issue, we used a file that contains service purchase upon retirement data that was provided by Tim's team. And we essentially developed this service purchase upon retirement assumption. And specifically, after analyzing all the experience, we kind of summarize it in the table here, where the total amount of service purchase upon retirement per year, the total number of new retirees, after excluding members that were eligible for unreduced retirement, we come up with this average amount of service purchase upon retirement. And then we ended up developing a load to apply to all of the members. So specifically, we recommended applying a service purchase upon retirement load assumption of 0.15 years of service for active members that are not eligible to receive an unreduced benefit upon their assumed retirement. And we excluded these members who are already eligible for unreduced retirement from this assumption, because members who are already eligible for unreduced retirement are unlikely to purchase service upon retirement because they're already eligible for unreduced benefits. So that was just one nuance about that. And then going forward, our plan is to begin applying this assumption during the fiscal year 26 valuation. And we'll kind of monitor the experience over the next few years to evaluate how well this assumption ended up working during the next experience study, or if there are potentially other issues that are causing the retirement losses that aren't tied to the increases in service or the retirement rates.
So practically speaking, Austin, what that means is like applying a 0.15 years of service load to everyone. It's sort of like saying at retirement, like one in every 10 people will purchase a year and a half of service.
Yeah.
But you don't know who those people are, so you apply the smaller amount to everyone.
Mm-hmm. Exactly.
And I think we can skip over some of these other details and go to 68.
Mhm.
68 is our kind of our cheat sheet on the impact on what the assumptions are, and kind of like when you change them, what's the impact on liabilities and what's the impact on gain loss. So we just point out that this is a nice reference sheet. And then the next couple slides, Austin, if you just want to point out at a really high level some of the things that are changing, but effectively these are the current assumptions and the proposed, and really what you'd be if you did we recommend adopting everything. The next couple slides show you what you're agreeing to.
Yeah, these next few slides are basically, they're good summary and good for referencing for the big picture of all the assumption changes, where we list the current assumptions for all of the assumptions and the proposed, basically how they changed or what types of changes we made, and then the impact on the ADC. So just to quickly skim through some of these, the increase in the inflation assumption had no direct impact, but it had a secondary impact based on the changes to the salary scale and the COLA, which we kind of discussed earlier. For salary scale, we only increased the inflationary component, which had a slight increase in the ADC. Similarly, for the COLA, basically all the COLA assumptions were increased by 10 basis points or 5 basis points. It's also had a slight increase in the ADC. Back to the mortality table comments, by updating the base tables from the Pub 2010 to the newer, more current Pub 2016 versions and updating the improvement scale, ended up producing a decrease in liabilities and a decrease in the ADC. And that's for all the mortality assumptions effectively. And for retirement, we made some adjustments to the rates, but as you saw, the rates were pretty close to expected for most of the larger groups. But in attempts to address some of the losses we've been seeing, we ended up applying that service purchase load. And all of these combined ended up producing a slight increase in the ADC or in costs. And then for an active retirement, that was one of the ones we skipped over. We basically slightly decreased the pre-normal retirement age rates to from 15% to 12.5%, which is a pretty non-impactful assumption, but at least now the new assumption aligns more closely to the actual experience. And for termination, we ended up adjusting the rates to kind of better align with the actual experience, but ultimately it was mostly an increase in the rates for the largest groups, which ended up producing a slight decrease in the costs or in the ADC. And for disability, similar to an active retirement, a relatively non-impactful assumption, but we ended up increasing the rates for groups A, D, F, and G by 10%, which had a very slight increase in the ADC. Sorry, lastly, for the spouse information, we had proposed no changes. And we have a prior slide with a little more info if you're curious about that. And then lastly, kind of the final slide, we just have the cost impact results again. That it's the same slide basically that was listed earlier in the presentation. So we kind of went through that already. So the big ticket item is that if all of the assumptions or all the proposed assumptions are adopted, it would end up increasing the liabilities by about $7.8 million. It would decrease the normal cost by about $0.8 million. The funded ratio would slightly decrease by about 20 basis points. And the ADC for fiscal year 27 would slightly decrease by about $0.1 million. So that kind of concludes our presentation. We can open up the floor if anyone has any questions or comments that they didn't get out during the presentation.
Any comments? I have
I'd
one quick one.
Go ahead.
And then I think Jay's going to chime in as well. As we track the service purchases going forward, is that going to sort of be embedded in the retirement costs as another layer or broken out separately? Just curious about how to kind of keep track of that change. I like that you dug in there and identified that. Just curious.
I think it'll just be I think it needs to be in the retirement bucket. So if you remember the page with the most numbers early on, that kind of the purple line and the 5 years of experience, it'll be within that retirement space.
Sure.
But hopefully that number will be relatively lower than it would be. Well, it will be relatively lower. We're just going to monitor, how much lower we can get those numbers. But it won't have a separate bucket, and that's how we're seeing it.
Yeah.
Because our system just says, here's the people that were in the data last year. We expected a certain amount to retire, and then when they did retire, here's what their liability is, and it compares the two values. So I don't think it doesn't really have the ability to easily bifurcate that out.
Mm-hmm.
Yeah, no, that makes sense to me. Thank you. Any other comments?
I'd like to move to adopt the Siegel recommendations, but is there a better way to say that?
Mr. Chair, I'd offer some language for Jay, perhaps to consider a motion to adopt the assumptions set forth in the June 2026 experience study as presented, effective July 1, 2026.
Thank you. So moved.
Do we have a second?
I'll second it.
Thank you, Beth T. So with the motion by Jay and the second, the motion to adopt the recommendations presented by Siegel is on the floor. Any discussion on the motion?
Just because this is my first real vote, I don't vote because I'm an alternate, correct? And I only vote in case I need to.
Yeah, that's correct, Lucas, but in this instance, I do not see, you are attending as a full member, because we are down one, VSERS member, so you would have a vote, as I see it, but if that interpretation is incorrect, please, offer that. I guess that's a question
No,
to
you're spot
you.
on.
Okay,
Absolutely.
thank you. And thanks for the clarifying question. Yeah, when a full member is not present, the alternate is attending as that full member and a voting member. So with that, any additional discussion? Seeing none, all those in favor of the motion, which is to adopt the recommendations as presented by Siegel, please signify with an aye.
Aye.
Aye. All those opposed with a nay. Hearing none, the ayes appear to have it. The ayes do have it, and the board has adopted the recommendations as presented by Siegel. Thank you, Siegel, and thanks to everyone at the treasurer's office for all the coordination, all the hard work that went into this report, working everything out. This is a huge effort and critical to keeping things on track here, and a lot of work goes into it. So I just want to thank everyone for getting it to this point and bringing it before the board here today.
Agreed. Yeah, and thanks very much for taking it up at this point. I think it gives us some more breathing room as we go into the evaluations over the summer. And so even though the liabilities and things in the aggregate don't change a lot, it's tempting to think that, oh, no big deal, but it is important to get these dialed in, and the whole 3-year cadence of these studies is a crucial part of our governance of the plans to make sure we're not letting things get too off track. The funny thing about these that I always love is that it's like one of the one things you do in life where you're voting on it knowing it's going to be wrong. The one thing we pretty much know for certain is we are not going to hit all of these assumptions, but it is getting us consistent with our best expectations. So
Yeah, I'd like to express my appreciation to Matt and Austin for a very clear presentation of some extremely complex information. So thank you for that.
Thanks, Jay.
Thank you.
And thanks, everyone. We appreciate it.
Mm-hmm.
Very well said, Jay. With that, the next item on our agenda today is the 457 plan design options presentation. And Tim, I don't know if you want to kick us off here too before we get into the real presentation, maybe with what you envision. It looks to me like this is really to put this on the table for everyone with a vote to follow the following meeting.
that's correct. And actually, I've been emailing with Sarah offline here as we went a little long on the experience study. So cognizant of time, what I've asked Sarah to do is really just give a 5-10 minute rundown of the deck to orient folks to what this is showing. We're not looking for action now, and I want folks to think about this, but it's really came about as a result of two things. One, our work with the restatements that remains ongoing. But Jay, appreciate your request for, hey, what's out there? What are new things we can consider? I've been telling Sarah, I think this is one of my favorite decks. I think it's really clear. I think it shows exactly sort of what's out there in understandable way, along with a consensus recommendation from staff and RFP about what the board may wish to consider. You don't have to consider any of it. You can, go whichever way you want on this. The only things where we would definitely say we would prefer folks not adopt are things that Empower is not ready to manage at present. So there's a lot of work underlying this, and really now, Sarah, if you could just, in 5 minutes, just explain to the board what this is, then we can folks can think about it, and we can come back at a future meeting to think about adoption.
No, sounds great. And good morning, everyone. So yeah, as Tim said, and with Jay's comment, I think it that certainly was a natural moment to step back now that we're working on a restatement project, and and ask, are there features available to a plan like ours that we haven't adopted, and should we be adopting those? And so staff and RBT have been looking at what's available, what Empower can support, but also what peers are doing, what Secure 2.0 is now making available. And that's what the goal of this presentation is to walk through with you all. So quick orientation, there has been already changes that the plan has already implemented over the last couple of years as a result of Secure 2.0. So the mandatory Roth catch-up took effect this year, the RMD age update to 73, and then the enhanced catch-up contribution for ages 60 to 63 or also took effect recently. And these are all Secure 2.0 provisions. And then everything on the right-hand side of this slide is a new provision that we think are worth reviewing. We organized them into 3 buckets by color here. So things we think are worth considering for adoption. We think these are potentially good enhancements to the plan. And then things that we are watching, as we think there could be good enhancements, but they're either not available yet, or we think more work needs to be done to understand and refine the way we may want to adopt those in the future. And then there are 2 things that we're not recommending that we think we should definitely revisit in the future, but are still there are still some uncertainties around the potential value add to the deferred comp plan. So we just put a pin in them for potentially maybe revisiting at a later date. Don't think they are necessarily high priority to adopt. I think this will be a good, the presentation itself go through each one of those options. I think some ideas on potential benefits, but also some considerations to think about. We think we can definitely walk through them in more detail at the next meeting, but maybe from on a high level, within the adoption, within the provisions that we think you all should consider for adoption, they really fall into 2 main buckets. So provisions where we think typical plan design has moved in that direction, and we believe adoption will just improve the plan functionality. And this applies to the first 3 in the list here. In-plan Roth conversion, which is something Tim has already previewed with this board. I believe at the last meeting, there was a participant request asking for allowing it. We think this is good functionality, good improvement. And then lowering the in-service distribution age to 59.5, something other plans are already doing, and the RMD installment payment functionality. And then the other 4 that are green here are ones that are really new provisions that address a specific participant need that we think current provisions don't address very well. They're trying to fill in a gap or potentially enhance the distribution provisions in one way or another. So these are the ones that we're going to want to spend a little bit more time discussing at the next meeting. So with that, I think that's maybe a good high-level preview. Tim, anything you want to add there?
Yeah, no, I think that that's pretty much it. I think, just to put a further point on it, I think in the deck, there's some good like one pagers on each one of the provisions in its own right. But for example, some pages 7 and 8 in particular, there's a little bit more high level context, like those last four that Sarah was just talking about, some of the provisions that are going to allow you access to your funds while still employed. I think there's a good comparison to sort of like how those events are kind of currently dealt with under the plan, and then sort of how to think about them under the new provisions. So appreciate both the one pagers with detail, and I think they're really good to review, but also some of these where there's a bit of a broader context to explain how Sarah laid it out, I think is really helpful. The one other thing I'd note is that I think we'd be remiss if we didn't put something about auto enroll in the deck, is that's a really important thing, and it's something that I think has a lot of value. That kind of has to be a separate work item because it has substantial impacts on all of our payroll officers. It has, it would have to be something dealt more in concert with our employee group partners, and I would, part of why the recommendation here is to evaluate separately is that, should the board wish to go down that road, that's not something that I think we can just say, yep, we're doing it and expect to happen in the same way we can with some of the other provisions. So really just wanted to highlight that we want to note it, but take that separately if that's a direction the board would like to go.
Thanks, Tim. John, you have your hand raised. The floor is yours.
Yeah, I just have a brief comment. I agree with Tim. This is one of the best slide decks I've seen in quite some time, and thank you for that, Sarah. As to your last comment that Tim made, I agree that auto enrollment should be considered. I think one of the first VSEA board meetings I was on, this came up, and the argument against was, oh, that money's really locked in tight. So I just want to point out that these other provisions that don't lock the money in as tight can feed for more positive impact from groups like VSEA to support auto enrollment someday in the future.
Absolutely right.
I just want to second that as well. This is one of the things we discussed internally with RVK and staff. The idea of those emergency distribution option is that if participants feel locked in, they're less likely to save in the first place. And this is something that is supported by research, and it really impacts the most vulnerable cohorts in the population, those of lower income who maybe have less means to save or may have more concerns around emergency distribution needs. So having this additional access, I think, has been shown to really support saving by folks who save the least. So completely agree.
Thank
and
you.
I think on that one where some of the biggest challenges come up, if this was just us coordinating with Commissioner Fastigi's team, that would be one thing. But as this, all the municipalities all have access to this. So we have there's a logistical piece that we would have to figure out, make sure that we could get this tied in with all of our municipal payroll officers and other partners that just make it a bit more of a complicated question. I think I would go as far as to say there's pretty broad support for this idea, and in the retirement space, as a means to effectuate savings, it's unquestioned that this is like one of the most effective tools. So I'm very interested in it and bullish about it. Just wanted to kind of flag the separate discussion needed.
Jay, floor is yours.
I'm in violent agreement with Tim about that. If this were a 401k plan, if it was the primary retirement vehicle, you'd hear me as a very big advocate of auto enrollment. As a 457 supplemental plan, the pressure is a little less, and still the inertia that happens about joining a plan like this and saving for retirement, you can really overcome that pretty dramatically with auto enrollment. So it's very tempting.
Very that comment sort of echoes. I've had these discussions amongst employees myself, and I think it's hard to imagine that this wouldn't result in better retirement outcomes. At the same time, there's already a significant mandatory contribution with the pension contribution itself. So that's just where the tension comes in conversations that I've had, and that doesn't mean that we shouldn't continue to sort of have those discussions. I guess the other thing I really appreciate from this deck, and I'm glad that you all took a look at what else is possible in a plan, because as you look some of those first three in plan Roth conversions for one, 62% of other large plans offer that feature. So I mean, it kind of identifies where we're a little behind the curve. And then if you look at some of those secure 2.0 provisions, 25, 28%. So we have an opportunity to kind of get ahead of the curve in how we design our plan. So I think this is a really good effort at looking at, how we could improve the plans for participants and looking at all the new avenues to do so. So thank you for putting this on our radar, and look forward to discussing this more at the next board meeting as well.
Oh, thank you all. And on the auto enrollment review that we can happily do for you all, part of that, and that's you make a really great comment on retirement readiness and outcomes, and that there are those other sources. And what we like to do for state, we helped other state plans develop an auto enrollment scheme, and what we would recommend is there is merit in evaluating all those additional income sources across your plan cohorts, and looking at the best design that would really complement those sources, verifying at first that there is value in this additional supplemental saving. What we've seen with other plans that we've worked with, especially where there has been pension reform and over the years, is that there is an important role for the DC plans, even a supplemental 457 plan to play to support those other more primary income sources like pension or even social security income, and understanding that tension and evaluating that on the state level for Vermont specifically and for its cohort is something we can support, and we think would potentially inform that discussion too.
Thank you. Understanding we're not going to take action on this here today, are there any questions from board members sort of focused on kind of helping to understand these provisions so we can kind of continue to digest it over the next month here? Okay. Not
And
seeing
Mr.
any
Chair, I'm just going to broaden your inquiry right there
Sure.
to say that as folks are looking at this, please feel free to reach out directly if there's a question you have, or if there's something that you're thinking about. We can do some work in the interim period if there is something else you want Sarah and I to kind of chew over before we come back to you.
Thank you, Tim. That's very helpful. I appreciate you putting that offer out there, so we can kind of flesh this out and come to the next board meeting, prepared to discuss and hopefully move action on some of these points. So not seeing any, but knowing we can reach out and have further discussion next meeting. The next item on our agenda this morning is the VSERS FY27 budget and approval thereof. Just to recap, we have seen this budget before. Tim took a little bit of a different approach in the timing of this year. Tim, do you want to speak to that at all here before we get into the budget itself?
Sure. You guys see my screen here?
Yep.
Great. Yeah. So just to go over our approach this year, what we wanted to do was make sure that we had the latest and greatest for you to approve as we are entering into our upcoming fiscal year. In the past, we sort of did the one-shot approach that was consistent with what we were recommending at the beginning of the legislative session. But things would change a little bit as you go through that process, unsurprisingly. So what we did this year in order to kind of marry up those processes that happen both at the legislature and here is we presented the bigger draft budget presentation at the same time as we always did at the start of the legislative session. And then over the past few months, we had our bill where we were proposing new positions and some changes to how OPEB is managed. Some other things happened outside of our that go on with other state agencies that impact our budget that is not directly within our control. And a final budget was approved by the legislature. I understand it was sent to the governor just recently, and I think just based on news reports, I think there's a broad expectation that this budget has support. So what we wanted to do now is just bring to you the what changed from the original budget. We appended in this presentation, our original presentation, so you can see the, what we presented back a while ago. And really there were two buckets of changes. One were the positions. We had approved a new policy and research manager here in the retirement division. Thank you to this board and the others for the support for that. I think that was very helpful in getting across the goal line there. And VPIC also had its additional position approved. So those two positions, increased both the administrative support line item and the VPIC pass-through line item. And you see the scope of those changes here on the slide. These are for the in aggregate, the combined systems budget. So the VSERS is a portion of it. And then ADS, there were some additional costs that we are paying due to increased utilization of cloud-based services to ADS that we didn't capture at the initial budget, but they're reflected here. So the bottom line, we have our combined system budget here, and you can compare this to what we provided before, which is later in the deck, but more important, the VSERS specific budget. Goes from about a 6% increase to a 12.8% increase year over year, due to those two factors that we showed before. Happily, I do think, kind of to harken back to our experience study discussion, we are still comfortable with that 45 basis point assumption with these new positions because, two things. One, we have come in under that expectation in the past experience period, and natural payroll growth also gives us a little bit more flexibility. So, we were definitely looking at that and discussing it with the actuaries as we were kind of reviewing that administrative expense assumption, and we're still feeling good there. So, this is the budget that we were asking this board to approve for fiscal 27, and happy to answer any questions you may have.
Eric, I'll move approval.
Thank you, Jay. Is there a second? I'll second. Betsy, we can take your second, actually. No need for me to second. So with the motion and the second, approval of the FY27 budget is on the floor. Any discussion on the budget?
Yeah, I'd love to hear a little more about the IT expense.
The IT expense, Bill, do you want to take a shot at that?
Yeah, absolutely. So importantly, when we were shifting over to the cloud-based system, there were some aspects of it that were believed, from my understanding, to be one-time expenses, and they may actually have more so been clarified to be ongoing expenses regarding this, because now instead of it being just a one-time transfer, we do have 5 servers for our office, and that, I believe, has a little bit more of an expense to it. I'm not sure of the details, of course, but that is what I've been told.
Thank you. That's helpful because I sort of had a question on that too. Was this part of a broader effort to get services on the cloud, or was it really specific to our own utilization of those services? It sounds like from your answer, it's specific to our needs.
Yeah, actually, I seen Jeremiah on the call too. Jeremiah, do you have any further insight into that for the board at this point? I do think that it is key to our, as my understanding, that it's key to our utilization of the cloud-based services.
Yes, I mean, I think Bill hit it right on the nose. I mean, there was somewhat of a shift in the way that we are utilizing IT, and you know, moving from physical infrastructure to more cloud-based services, and that will, I believe, be an ongoing expense.
And this is exactly why we wanted to kind of do the two-shot approach. You know, there's the what we know and expect early on when we're doing the initial proposed budget, and then inevitably an evolution as, you know, folks are questioning it and prodding it. So yeah,
It
there's
validates the
there's a little-
concept. Yeah.
little push and pull there between the security of the data when we're doing it ourselves versus the resilience if there are data processing issues, having it out there in the cloud. It's better backup out there, better support out there. So and overall I support it, but it's sort of a breathtakingly large increase given the scope of the the budget.
Thank you. Any additional discussion before we move to a vote here? Not seeing any. So the motion on the floor is approval of the FY27 budget as modified from our draft, from the draft that we previously viewed. So all those in favor of approval of the budget presented here today, please signify with an aye.
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 Aye. And all those opposed, please signify with a nay. Hearing none, the ayes appear to have it. The ayes do have it, and the VSERS FY27 budget is approved by this body. Next up on the agenda today is the annual review of the contracts that we employ to sort of help take care of our obligations here. Really good review to see what's out there. Tim, do you want to lead us off on this, or how do you foresee this or actually maybe Justin, this might be you in your purview?
This is going to be Justin.
Okay.
This is something we started doing, I think, last year. Justin's doing, an excellent job overseeing the whole group of contracts that we have. And so this is an annual opportunity where he's just sharing, really just the high points, who it is, what we use them for, and mostly sort of an awareness piece, so the board kind of can see all the partners that we're actively engaged with. Thanks, Justin.
Excellent.
Yeah, absolutely. Bill, can you share the deck?
Absolutely happy to. One moment.
So much. And I know a lot of board members have been here. I did leave in sort of the overarching contracting principles. I know we have new board members, and just for refreshing for those folks who don't work with contracts for a living, just to understand. There you go. Thank you, Bill. And you can move forward, please. Or can I? No, I think you have to. Perfect. Yeah. So just letting folks know, and I think the point of trying to give an overview is just so folks understand the cadence. So, we generally try, just like what you folks just did with the VSERS budget, if a contract needs board review, we make sure to sort of let you know of, hey, here's an RFP process that's beginning, and we sort of keep you updated. But I think the thought here is being able to zoom out so you understand sort of the cadence, what might be coming down the line. And it's just a time to see how many contracts that, sort of help get the work of VSERS done. And as a reminder, we do live in a very constricting world of contracts. We don't, as I have to explain to vendors all the time when we get to negotiating points, we don't exist in a vacuum. So even though this board, for instance, is created by statute, if we still have to go through RFP, or on the front end we have to go through a process, either a simplified bid, but it's all very structured in what we call Bulletin 3.5, which is put out by the Agency of Administration. We work with our Attorney General office partners. We have an AAG who helps look at it from that perspective. And we also go with our Agency of Digital Services partners for anything relating to data, which frankly, almost every contract these days has that component. So that's just the sort of overall viewpoint. And if you could go forward, please, Bill. Yeah, perfect. And this is just as an aside, you'll notice on our next slide, which is our overview, you'll just see that there's different years, so that some contracts you have a max of 5 years. Those are contracts that the sort of everyone agrees it's good to go out for an RFP to keep seeing, refreshing the market, seeing what's out there. And there's other contracts like LRS for Pension Gold and Empower, where I think the state has decided that it makes more sense, given the tumult that can happen with frequent turnover and how long it can take to onboard and offboard contractors, that it makes more sense to have longer periods of time. And so those are contracts where you can actually extend. You still have to, we don't have automatic contract extensions, so everything has to be done willingly and knowingly and affirmatively, but you could actually have 3 5-year contracts for those. So just reflects the difficulty in managing those services.
And Justin, can I jump in on the LRS piece? That's sort of an even more unique beast. That's the pension administration software system that we use. That's really sort of the engine that powers our system. And we own that. Many years ago, when we first made the move to LRS, we bought the solution. That's not a typical model anymore. It's these services are much more subscription based at this point. But because we own the underlying system, the contracts that we have with LRS are for maintenance and support and for hosting services. So they're not for use of the system. We have that, but we need to keep it updated, and that's what the contract is, to keep the system updated, to keep it in a secure environment. And so Justin's talking about, like, that makes sense on a 5-year cadence to look at this one. Just for perspective, talking to other system directors around the country, a transition of something like this is probably in itself a 5 to 10 year project. These are sort of massive efforts, and right now we have a good tool that, even though we've had it for a while, it's something that's working well for us and is providing the necessary functionality. So it is technically subject to the waiver plan, but I would even put that specific contract in a more unique place, just given the nature of it. Yeah. Thanks. Sorry to interrupt, Justin.
No. Thank you. That's great context. And I would also just point out the waiver plan is an optional sort of enhancement. But if, for instance, the board or the the treasurer's office, for those contracts that we control, if there was a decision made to go and say, no, you know what, actually we want to go revisit the market, nothing binds you to it. It just permits you to extend if you want to. So Bill, could you move forward, please? Thank you so much. And so this is a little bit of a snapshot. I will note it feels like contracting was really fast and furious for a little while. So I will note with glee that there is nothing with a 26 in it here in front of you folks for contracts that affect you. We certainly have a lot of work to do in terms of contracts overall, but right now we're at a really nice place. And so I did list just to give an overview, for instance, outside counsel first, this is our first contract with them. I would envision that we are going to do another RFP in 2027, probably late 2027, just to, evaluate, is this still the, make the most sense. Thomson Reuters, that's something where that's split between retirement and unclaimed property. So I'm sure we'll have discussions about that for subscription services, things that we call basically the ability to match information. Delta Dental, as you can see, that is our, next year, I would imagine, I leave that to Tim, but that'll be the 5th year of our contract. I would imagine that we are going to see a global RFP or some sort of procurement process, but I don't want to speak for Tim, but that's on the horizon.
Yeah, I would expect the same. I understand DHR is out right now this year for the actives, and so we always are eager to learn from our partners over there what they're seeing in the market. But I would expect an RFP not this year but next.
Right. Yeah. RBK, I will note the OPEB, given the the soon sign. I don't believe it. Has the governor signed the omnibus bill, Tim? Looking at you or David.
I don't believe yet.
Okay. That's what I thought. Given the pending planned statutory transition of the OPEBs, we could, that contract, we'll see how it works. There will be some discussions with VPIC, I'm sure, about how that looks. And then so RBK and Siegel, who obviously you heard from today, we have quite a bit of time left on those contracts. And as Tim explained wonderfully on LRS, and then to a lesser extent Empower, which is on both of those are contract waiver plans. And then we use a law firm of Powers and Powers for disability retirement hearing appeals. So that is a neutral third party who hears those appeals. And so that is, once again, thankfully, years away from termination. So, and if you go forward one slide, please, Bill. Yeah, that was just giving the folks and what we'll do, now that we're on this, at least once a year cadence of just helping to zoom out. Not only will you, be hearing from us as we talk in board meetings about, hey, this RFP process is starting, or, here we are, we're contemplating options, but we'll also be zooming out so you can just see overall, and we'll be sharing this deck as it updates. So yeah, really, I didn't want to put anything too far out. So the Delta Dental RFP, which is, still some number of months out from needing to contemplate next steps. So I just wanted to put that on the radar. As always, reach out to me for anything, if helpful. Always happy to spend a lot of my waking hours talking about contracts and contracting. Not that it doesn't interest a ton of people, but always happy to answer any questions or discuss anything that folks might want to. So I appreciate it.
Well, Justin, thank you for that overview. One quick question, if you look at that list, you have the two that are identified as being, if you look at the amendments column, two identified as being in the contract waiver plan, which is the 5-year windows. There's, 3 contracts above those two that have amendments available. Some are different than the, 5-year terms identified in the contract waiver plan. What makes those separate? Those extensions were just explicitly identified in the contract negotiations, or what makes those different from the CWP?
And I don't know if it got cut off. RBK should have in the OPEB. I thought that they should have a CWP next to it, but generally it is that we can petition to have contracts in our contract waiver plan. The treasurer's office controls it. So it contemplates what kind of contracts are in there. So that is sort of what defines. And I think historically it's been, for instance, Jeremiah's here, like cash management, bank contracts, for instance. I think those are of such a kind that it's hard to transition. And so you want that longer position. So it really comes down to what is contemplated in that, which I'm happy to maybe that would be helpful. I can certainly share the contract waiver plan, but that is what controls it. It's not necessarily any contract could potentially be. It's a process you have to get, various approvals for, but that's sort of what dictates it.
Yeah,
Excellent.
I think for us, it's really at core of the business need. Like sometimes it makes more sense for us to just strike a longer single term contract within the limits. Sometimes, particularly for newer folks, I like to have, I'd prefer an out. So, you want to have a smaller initial term with a right to extend and, a pre-negotiated cap or something like that. So a lot of times when we're thinking about this, practically speaking, it's, we're thinking about like is it a known partner? Is it a new partner? Do we get best value from a longer term, or is the value of a potential out more important to us? So it's kind of how we think about it.
Thank you. Appreciate that perspective. Any additional discussion before we leave this topic? Hearing none, the last item on our agenda today is any other business to come before the board at our June meeting. Does anyone have any other business they'd like to bring to the board this month?
I will just note for planning purposes, I am going to endeavor to have a July meeting and maybe give an August off month. Kind of got to see how things develop, but that's sort of goal for the summer right now is I'd still like to revisit the 457, some other things in July. Depending on where that goes, there's a possibility of flip, but one of those I want to have an off month. I'm sure everybody else does too. So just wanted to flag that goal. Presently thinking August will be that month.
Thank you. No, it's helpful to have that big picture.
So that would switch us off our normal cycle with Empower, wouldn't it?
Oh, it would, wouldn't it? That's what I didn't think about, Jay. Thank you for that insight. It may be July, and maybe we want to do August. I feel like it's if I can, 1 or 2 months off is I think a best approach. Thanks for flagging that. Okay, let me talk to Sarah about it may be that we kick off July and come back for August. I'll follow up. I'll make sure that, we'll do some planning over the next week, and I'll follow up with the board. I know people will want to kind of plan for this.
Thank you. Any other business to come before the board this month? Not seeing any. It might appear like we could be ready
move
for
to adjourn. Eric.
Thank you. Thank you. And that almost puts us on perfect timing here. So there's a motion to
10
adjourn.
minutes late to my guitar lesson.
Is there a second to Jay's motion?
I'll second.
So with the second, the motion to adjourn is not debatable. All those in favor, please signify with an aye.
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 Aye. All those opposed with a nay. Hearing none, the ayes appear to have it. The ayes do have it, and the June meeting is adjourned. We had quite an
Well,
agenda
everyone.
this month. Yes, so thanks for everyone's attendance and discussion. Same. Take care.
Yeah, thanks a lot. Appreciate it, folks.